All right. Today is Wednesday, the 22nd of February, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight, and let's begin with this. You know this new generation of monkeys who are behind the so-called monkey rally that started this year? They're a different kind of breed than what we've seen before. Even the AMC apes are going, yeah, we've done dumb stuff before, but these people are crazy. Why are they crazy? Because at least the AMC mania, the GameStop mania, the whatever mania, happened under zero interest rates by the Fed. And theoretically, when you have zero interest rates by the Fed, you can pump up valuations as high as the sky, as high as the imagination can go. You can hype things with no profits, with no cash flow. Doesn't matter. It's all about the growth. It's all about how many subscribers a company is gaining each quarter. It's all about the revenue growth. Yet when interest rates start to move higher, then there is a limit to how high valuations can go. There are many reasons for that, mathematical reasons, logical reasons, such as the TINA argument, which stands for there is no alternative. You gotta buy equities. Well, now with higher interest rates, we do have alternatives, and therefore there is a limit to how high valuations can go. Specifically when you have an environment where we're not even sure how high interest rates will go. To begin with, what initiated the monkey rally, if we can look for reasons, of course, there are no reasons. The reason is just a stampede. But if we try and pin it on some reason that makes sense, the only one is, inflation was going down, and therefore the Fed will cap interest rate hikes, either by pausing or maybe cutting later on. But we can see the light at the end of the tunnel. If inflation is going down, then there is no need for more interest rate hikes. And as you can see, when we look at the month-over-month growth in inflation, the trend was down. The growth month-over-month in inflation was trending down. Unfortunately for the geniuses, along with Jerome Powell, of course, they declared victory prematurely by saying that this was a legitimate disinflation process, when in reality, you don't have a disinflation process in the economy until the underlying conditions for inflation are gone, which we know they're not. So this assumption that we had a disinflation process in the economy because the CPI month over month was trending down, let's say was the catalyst behind the monkey rally. And of course, the chairman of the Fed poured more gas on the fire by saying disinflation 11 times and saying that the disinflation process in the economy has begun, only for the next inflation month over month in the CPI coming out really, really hot. And then we have the oops moment. We made a miscalculation here. We made a mistake. And immediately we have a reckoning. Bonds have to correct course. So did gold. So did commodities. So did the dollar. Exception, the equities market. But now we're starting to see the equities market also getting the memo. Yet it continues to fight because market participants, at least some of them who are behind this rally, are saying, no, we have to cling on any piece of hope left. That maybe the bond market is wrong. Maybe gold is wrong. Maybe the dollar is wrong. Maybe the CPI data is wrong. Maybe the laws of the universe are wrong. Maybe something will happen. Something magical, and we will be proven right. The problem is that the evidence is mounting against them. And of course, this week we have the PCE inflation rate, and that could seal the deal. That pretty much every inflation metric we got, be it the CPI, the PPI, the PCE, all indicating the same case. That inflation is rebounding, that inflation is not dead, and it's going to take more aggression by the Fed to take inflation down, meaning interest rates will have to move higher. Now that opens a lot of opportunities. For example, if you look at the risk-free one-year returns, it now stands at over 5%, something we have not seen in decades. This is an opportunity open right now. Risk-free, you get more than 5%, and I know that the retail mom and pops will say, hey, 5%, who cares? That's nothing. I like my gains to be 40, 50, a million %. We'll see how that's going to end by the end of the year. But we're talking about the professional money managers who are managing hundreds of millions, if not billions of dollars, and they're judged by the performance of their portfolios by the end of the year. Having some money parked at 5% risk-free is nothing to sneeze at, especially when we look at the valuations in the equities market and interest rates moving higher. A lot of valuations don't make sense. And that leads us, when we talk about more aggression by the Fed, we have to revisit the wall of worry. And the first item we're revisiting is the Federal Reserve. And here it is. Now, the most important event that took place today is the FOMC minutes, which we know a lagging indicator because a lot of things changed since the last FOMC. We got the CPI, we got the employment data, we got the PPI, all hot, retail sales. So a lot of recalculations will happen in the next meeting. But regardless, here's the headline from the Wall Street Journal. Most Federal Reserve, and listen to this, by the way, because this is amazing. This is misleading. But anyways, most Federal Reserve officials thought slowing the pace of interest rate increases at their meeting 3 weeks ago offered the best way to balance the risks of doing too much or too little to combat inflation. Now, when you read the headline, what is the impression that you get? Oh, in the next FOMC, it's going to be 25. So there is no reason for me to be alarmed that, hey, equities will go down by the Fed becoming aggressive all of a sudden. This is the impression that you get, and it's not a surprise because it is written by Nick Tamaros, who's in effect just Steve Leisman Jr. So my expectations are low to begin with. But in reality, what the headline should have been is this. Take a look.
International economics and policy correspondent live from the Federal Reserve.
Well, at their February 1st meeting, Federal Reserve officials saw what you were seeing in the economy, an economy that was slowing, a still tight labor market, and inflation still well above their 2% target. Growth had been below trend in 2022, the minutes say, and had nearly stalled in the fourth quarter. But the minutes say the participants agreed the risks were still to the downside for economic activity. They worried about an unexpected negative shock that could, quote, tip the economy into recession in an environment of subdued growth. The decision to raise rates by a quarter percentage point was cast as a risk management measure. Many officials felt, quote, a further slowing in the pace of rate increases would better allow them to assess the economy's progress as well as progress towards the Fed's 2% inflation target. Not all, however. A few participants, that's the phrase, favored raising the benchmark rate by 50 basis points. Now, we know from their own comments that Cleveland's Mester and St. Louis's Jim Bullard were in that group. A few generally means more than two, however, but we don't know how many were involved. Their view was moving half a point would get them to a more restrictive level that they wanted to be at more quickly.
Now, remember, in the intro of the video, I showed you the rolling month-over-month CPI. So the last FOMC was looking at that particular piece of data. And even with that, we had a few, not a couple, a few Fed members who thought that the Fed should have gone with 50 basis points, not 25. So the real headline should have been, hey, in the last meeting, inflation was rolling down month-over-month. And even with that, there were a few Fed members who thought that the Fed should have gone with 50 instead of 25. Now that we know for sure that inflation is rebounding, that wage inflation remains too hot, that we have more inflation coming in the pipeline, according to the PPI, when we have retail sales data exploding higher, when we have consumer credit card debt going out of whack, don't you think that the few quote-unquote Fed members who thought that 50 basis points was more appropriate in the last meeting will be joined by more voices in the Fed in calling for a 50 basis points hike in the next meeting, now that we have new updated data pointing out for more inflation to come? And this should have been the headline instead of the bullshit of, oh, most Fed members thought that 25 basis points is the way to go, and in the next meeting they're going to do 25 again, which, once again, the purpose behind writing such bullshit is to pump the stock market higher. And that's what journalists, quote unquote, do these days. Unfortunately, of course. But now that we have this information, let's play a game. Let's figure out who the few are, because we know two. We know Bullard and we know Mr. called for 50 basis points, so we got two. And now the mystery becomes, who is the third zombie who also thought that 50 is better than 25 in the last meeting? And who else will join them in the next meeting for calling for 50 basis points, if not more? Now, here's the zombie board, and we have voting members and we have non-voting members. We start with the voting zombies. We have Jay Powell, the big dog. We have Governor Braindead. We have Governor Barr. We have Governor Lisa Cook, Governor Michelle Bowman, Governor Waller, Governor Jefferson, along with from New York City, which is a permanent voting seat, by the way, John Williams, along with Pat Harker from Philly, and Austin Goldsby from Chicago. This is the new guy. We have Lori Logan in Dallas and Neil Kashkari in Minneapolis. Minneapolis. Now, the non-votings, Raphael Boistick, Atlanta, Suzanne Collins, Boston, Loretta Mister, Cleveland, Tom Barkin, Richmond, which I hear a lovely city. Matter of fact, Tom Barkin can't wait to retire so he can get the fuck out. But anyways, Mary Daly from San Francisco, Esther George from Kansas City, she's retiring, and then we have Jim Blaze from St. Louis. Now, we can divide all of these zombies into doves, hawks, and neutral. I say the doves are Jay Powell. I don't know what happened to him. Maybe the magenta tie, maybe the thing ate some brain cells. I don't know. Something happened to him. And then we got Brain Dead. She's the most radical member of the Fed, but she's going to go out now, so who cares? The rest of the governors, Barr, Bowman, we know they're doves. There's nothing new here. And of course, we have John Williams from New York City. He plays a hawk right now, but we know at heart he's a dove. And the moment the stock market goes down by a little bit, he's going to flip and call for interest rate cuts. Not pauses, cuts right away. And then we have a new guy from Chicago replacing Evans, Austin Goolsbee. Now, what we know about him that he was a tool when he worked under the Obama administration, but back in the day he used to work for Chairman Volcker. Did he learn anything from Volcker? I doubt it. And then we have Esther George. She's gonna go, so who knows. Raphael Boistick from Atlanta. He believes in the casino economic model. Keep pumping the stock market with low interest rates, and if you're poor, you can't afford a house, that's your problem. Why don't you join the game and gamble in the stock market so you can get rich too? And then we have Tom Barkin. He's a dove. Nothing new here. Mary Daly, same story. They all play hawks right now, but they're doves at heart. There's nothing new here. Then we have the neutrals. Some of them new, so we don't have any background on them, such as Governor Cook, Governor Jefferson, and Suzanne Collins from Boston, Lori Logan from Dallas. And then we have two that we're familiar with, Chris Waller and Pat Harker from Philly. Once in a while, they issue really dove statements. Other times, they issue really hawkish statements. So for now, we'll say they're neutral. And then we got the hawks. And by hawks, I mean actions speak louder than words, meaning you can talk hawkish all you want, but at the end of the day, are you voting for 50 or not? Are you voting for 75 or not? Are you at least voicing your opinion that rates should go higher or not? We know that Jim Blaze from St. Louis and Loretta Mister from Cleveland, now that they're not voting members, all of a sudden they come out and say, oh, we should have gone with the 50 basis points. Matter of fact, I thought we should have done 50 instead of 25 in the last meeting. But the most important one is the last hawk, who used to be the dove of all doves, but maybe, he's the only rational hope here, and that is Neil Kashkari, the demon from Minneapolis. Now the mystery becomes, was Neil the third zombie who called for 50 basis points instead of 25? Because if that is the case, Neil is a voting member. Jim and Mr., they're not. So Neil holds a lot of weight here. A lot of you told me today, no, it was actually a female member, and that takes Neil out of the way. If that is the case, I don't know how you got that information because the minutes did not specify anything by gender. They would not do that, but anyhow, if that is the case, then my guess would be Esther George from Kansas City. Now that she's retiring, she's getting out of the way, maybe she can be honest. But the question now becomes, whether be it Esther George or Neil Kashkari, which members, specifically which voting members, are going to flip to 50 in the next meeting? Is it going to be Jay Powell? Maybe if we have Jackson Hole Powell, but if we have Pussy Powell, it's not going to happen. Brain Dead? I don't think so. If it is up to her, she'll cut rates right now, this moment. Michael Barr, the governors, Bowman, they're all zombies. They're going to go with the flow. I don't think they're going to change anything right now. Is it going to be Waller? Maybe. Lisa Cook? That's a wild card. Jefferson, same story. But we know they're all corporate hacks, by the way. So my hopes are down. So let's assume that all of the governors are going to go with 25. What about the presidents? Harker could be a case where he's going to move to 50 instead of 25. Neil, after all of this hawkish talk, he better go with 50 than 25. So we know that Neil is in the back. Let's say Harker is in the back too. So now we got two voices for 50, at least. These are the voting members. What about Lori Logan from Dallas? She's been talking hawkish as of late. Will she put her money where her mouth is and go with 50 instead of 25? And then Williams, what is he going to do? All of this hawkish talk about front-loading interest rate hikes, well, you got the opportunity now to put your money where your mouth is. Go with 50 instead of 25. So we do have possibilities here. We have more voices that could flip to 50. Will that convince the big dog to go with 52? Because if he recovers from whatever brain disease that he got and he decides to go with 52, well, guess what the market is expecting right now? The market is expecting higher rates, but the market is expecting increments of 25 basis points. Instead of 1, the market is now pricing 2 or 3. But the surprise element becomes, if the Fed goes with 50 in the March meeting right away, and then the unknown becomes how many 50s to come. And that would be a massive reckoning for the equities market, because now all of these valuations have to be trimmed in a meaningful way. What do we have on Friday? We have the core PCE inflation, which the Fed looks at, the Fed's favorite inflation measure. And it is the Fed's favorite inflation measure because it is cooked and it has the tendency of suppressing the true nature of inflation. But if it does come out hot, we have a lot of indicators that it will, then the odds for 50 basis points in the next meeting will become the consensus. And if that is the case, here comes the recalculation of valuations in the equities market, which means it will be the nail in the coffin in the monkey rally. We got the bump, the speed bump, that slowed down the monkey rally. We got the break in the monkey rally, but there is still the recency bias. There are still folks believing this dip is a discount worthy of buying. We're going to go higher again. But if 50 becomes the consensus by the Fed, then that would be the nail in the coffin that will end the monkey rally once and for all. And it could be the catalyst for the stock market to go down to the lows once again. Speaking of, let's move on to the coverage of the stock market, and we begin with the closing of the indices today. And here we go. The Dow Industrial Average was negative by 84.5 points, or a decline of 0.26%. The Nasdaq was up slightly by 14.77 points, or a gain of 0.13%. The S&P was down by 6.29 points, or a decline of 0.16%. We will look at the sector performances today. Coming up, number one, capturing the gold, the silver, and the bronze. Consumer cyclicals, thank you to Amazon and Tesla. The laggards, led by real estate, energy, and materials. The dollar is going higher, yields are going higher, real estate should be down, energy should be down, metals should be down, and tech should be down. But tech is where the irrationality is going on right now. What about the advance to decline ratios? NYSE 47% advancing versus 52% declining. The Nasdaq 47% advancing versus 51% declining. We talked about the suppressed ratios from yesterday, and the natural reaction to that is going back to the neutral line, which is around 50-50, and then we take it from there. Who has the better argument now? The bulls or the bears? Who has the better technical setup? Who has the better mechanical setup? We'll talk about all of that in the options, heat map, and chart analysis. But in the meantime, let's do commodities and see what's going on here. The dollar all in all was up, specifically after the Fed minutes came out. Now we know when the dollar goes higher in expectations of more Fed hikes, commodities should be down, and therefore energy down big for the day. Both the WTI Brent down by about 3%, so was gasoline RBOB, so was the heating oil futures, the metals, gold, silver, even copper was down today. Palladium was the loser by almost 3%. Mostly a down day for grains, with the exception of course being in softs, led by OJ and coffee futures all closing green for the day, but this is related to Brazil. OJ and coffee futures got hit really hard when we had the volatility in Brazil, the political situation, also the weather situation, but now that that's behind us, we're seeing that OJ and coffee futures are catching a bid. The real story, however, comes in natural gas. Now we've been waiting for nat gas futures to bottom. The decline in natural gas prices makes sense, but this massive crash doesn't make sense at all. Knowing what's in the pipeline, knowing what the challenges are going to be in the supply front, knowing what the demand front is going to look like once Europe exhausts the supply that they have right now. So we've been waiting for the bottom in nat gas. And you guys know that I've attempted to catch the bottom at least 2 or 3 times in nat gas, and every single time I ate a pie right in the face. Now, make no mistake, I love pies. Not the too sweet type. If it's going to be blueberry or cherry alone, you got to mix it with something else. Cheese, I don't know. I like the sweet/sour type. How about classic American pie? But too many pies in the face, that's not good. Yet we're hearing more and more voices saying that this is the bottom in nat gas. Now here you see it up over 10%, but in reality it was up about 4% or so in the March contract. This is just the difference between the February versus the March contract. So we have a premium to begin with. And the question now becomes, was the pump today due to the change in contracts, or was the pump today the beginning of something new? Is this the bottom in nat gas? And if that is the case, all eyes, of course, on BOIL, the ticker BOIL. Very dangerous, risky, but if this is the bottom in nat gas and we're about to see a short covering rally, then BOIL is the place to be. And getting stung a few times, you buy it, it doesn't work out, you get out, you buy it again, whoops, it's not the bottom in natural gas, you get out. So long as you get out, that's okay. You're gonna get it at some point. And when you get it, the gains will make for the losses and then some from the attempts of catching the bottom. Now you know my take. In these high levered indices, be it BOIL or whatever, SQQs, TQQs, it doesn't matter. You rent them, you don't buy them. When we have a short covering rally coming, you buy BOIL, for example. Once the rally stalls and stops, you take your profits and you rotate to something more sustainable, such as natural gas stocks. A lot of them outperformed today. Or you also got fertilizer fertilizer stocks, which I believe will outperform actual natural gas stocks if we indeed have the bottom. I'll tell you why in my natural gas video, which is coming out tomorrow. I know I've been slow, but I'm almost done here. But here's a sneak peek for you. We have the ticker LNG for Cheniere. This is a weekly chart. We have a trend line. It is a steep trend line. The name is reporting earnings tomorrow. Let's say the name crashes, which I'm hoping for, and it goes all the way down to the support of around 130. And then indeed we get the bottom in nat gas. We see nat gas building on the gains, more signs for short covering. You look at the call options activities for the ticker BOIL, because that's how people catch the bottom. If we start to see more activities in buying calls in BOIL, then we have more and more indicators that this is the bottom. And if LNG goes down to 130, that would be a delicious buying opportunity, even more delicious than an apple pie. But it all depends on whether indeed we have the bottom in nat gas or not. We have an unusual options trade for the ticker BOIL. Somebody bought call options today. Maybe that is a leading indicator. So why don't we skip to the options market coverage? And here it is. Welcome to the big casino. The volume is moving a little higher, which indicates the appetite of dip buying again. A lot of folks not believing that this is the end of the monkey rally. They believe that there is more to squeeze here, and they're buying the dip, they're buying calls. And the hottest table remains Tesla, the souffle, with around 2.7 million contracts traded today. About 56% of those were calls. At number 2, AMC, with around 900,000 contracts. About 55% of those were calls. Apple, the big kahuna, at number 3 with around 850,000 contracts traded today. And look at this, 53% of the volume was puts, not calls. Now, if the big kahuna goes down, if people are bidding for the big kahuna to go down, you really think the SPY, the Qs, will go higher? As Apple goes, so will the market. Now, I want to spend a little time talking about NVIDIA, and the reason is the importance of NVIDIA is not only because it is a large chip stock or a large technology stock. It is also because it is a sentiment indicator. The crowd loves buying the dip in NVIDIA. We have these bear market rallies, these mania phases. NVIDIA usually leads the way along with Tesla, AMC, etc. So if NVIDIA goes down, if NVIDIA reverses, then we got a problem because it means that the sentiment is changing. Rationale is coming back into the equities market. What did we get after the bell? NVIDIA's earnings. And for now, the markets love them. We see NVIDIA up about 8% after hours. Now, I'm going to answer the question on why certain stocks pop higher 8, 9, 10% after hours. Others go down by 9, 10%. What's going on here? I'll explain to you exactly why, where the opportunity resides. Here's an hourly chart of NVIDIA. We know that we got a double top formation. After that, the chart gapped down all the way to the support, the most important support, of 207.86. We do have a gap open at 220. Now, this is my earnings play that I announced today, buying the 200 puts with the expiration date of this Friday, and that cost about $3.35 a piece. And then sell the 195 puts, same expiration date, for $2 a piece. All in all, the entry cost is 1.35 cents. The profit potential is $5 a piece. And the reason why we're doing this is to dip our toes in with minimal risk involved. We know NVIDIA is going to go down, but what if it pops after earnings? Instead of buying the 200 puts for April, June, and pay an insane premium for that, the premiums will go down after earnings. So the safest way to play it is this structure right here, because the only risk we got is $1.35 a piece. We know that NVIDIA is up about 8% after earnings, and this makes this trade toast for the most part. There is a way to fix it, but it involves opening a new trade. There is a possibility, but it requires unusual events to happen for the trade to be profitable again, because we got 1 day till expiration, folks. I'll show you what will happen in NVIDIA's chart in a minute, but we go back and answer the question, why do certain stocks pop by 5, 6, 10% after earnings, and others go down by the same amount? The answer is mechanical reasons. It's all about options and what the market maker / the dealer will do. We'll look at the options expiring this Friday. Where is the highest open interest for calls? The answer is the 220. Where's the highest open interest for the puts? The answer is 200. So immediately when the earnings report is out, the dealer has to look through the numbers quickly in a matter of seconds and make make a judgment. And if the immediate impression is, oh, these are good earnings and higher we're going to go, then the dealer has to cover the rest really quickly because those 220 calls might become in the money, and that obligates the dealer to take a loss at NVIDIA. So what they do right away is immediately buy NVIDIA stock all the way and pump it above 220 to make sure that they're covered, that they have enough shares in case those 220 call holders want to exercise their options and own the stock. In that case, then the dealer is hedged. They already bought NVIDIA shares after hours for 207, 210, 215. They're going to make a profit in case these folks choose to exercise. Now, the next question becomes, why do we see certain stocks after the report comes out popping 5, 6, 7, 8%? And then in the next day in the morning, they lose it all. What's up with that? The answer, once again, comes from the mechanical reason. What feedback is the dealer getting? Let's say NVIDIA opens higher because this is the implied open range. We have 220 all the way to 230. Let's say that NVIDIA opens at 220. And then immediately, those holding the 220 call options with the expiration date of next Friday, I should say this Friday, they start booking profits and closing contracts with no rollover to say next week's call options, the 230 to 250. And instead, we see folks buying more puts as the stock moves higher. We see next week's 200 puts catching a bid. If the feedback that the dealer is getting, or the 220 calls are booking profits, and now we're seeing more positioning in puts, then we see them dumping shares right away, and we see the gap and crap phenomenon, where NVIDIA opens in 220, faces resistance right there. We see changes in the options positioning formation, and the dealer dumps right away. Then if it goes all the way down to the support of 207.65, and it loses that support, that would be a shorting signal. Now, does that mean averaging down in the 200 puts that you have right now that will probably be worth about few cents a piece around the opening tomorrow? Perhaps, if that's what you want to do. But that's a lot of risk assuming that we have one day till expiration. The more rational play would be opening the 210 or even the 200 puts, but with longer expiration dates. But we have another scenario that could happen. Let's say NVIDIA opens at the upper range at around 230. Now it's facing enormous resistance from the double top. If it makes it above that, and it will only make it above that if these 220 call options holders roll up either to the 230, 250 with the expiration date of this Friday or beyond, then the dealer has to buy more. And the put options, they're toast, they're gone. But let's say it hits 230. Then the dealer gets negative feedback. Call options holders are now booking profits and they're actually buying puts, betting for a U-turn. If the dealer gets that kind of feedback, then we're going to see a gap and crap all the way down to 220. That is support number one. If that's broken, then you got the signal to at least 207.86. And then if that's broken, then you got the signal all the way down to 200. But that's going to be for March, April expiration. If you do have a Bloomberg terminal, for example, you're going to see the feedback right away. If you're using another service such as Bar Chart, which I'm using right now, the data will be delayed by about 10 minutes, 10 to 15 minutes. But your broker might have live options data. So make sure whether you have that or not and watch the change in open interest because this is what the dealer is looking for and the stock of NVIDIA will move accordingly. Enough said. Moving on to the unusual activities that took place in the options market today. We begin with the ticker TEVA, TEVA. Now I believe that Warren Buffett used to own the name at some point, but this is quite an unusual trade. Somebody knows something here. It's a calendar call, my favorite kind of trades. Somebody bought the 10.5 call for the expiration date of March 17th, and they sold the same contract, 10.5 calls, but this time around for the expiration date of March 3rd. And the bet here is that Teva will be above $10.5 a share by March 17th, but not by March 3rd. All in all, they paid around 20 cents a piece for the long leg, the 10.5 with the March 17 expiration, and they received in credit about 6 cents a piece from selling the 10.5 calls with the expiration date of March 3rd. All in all, the entry cost is reduced to about 14 cents a piece, which brings the total amount spent for this trade to about $550,000. And here it is, the ticker BOIL. Now, when I see such a large trade for a high leveraged index, somebody knows something here. We talked about the unusual trade where somebody bought calls on the SQQs, and immediately the Qs went down, and in effect, the SQQs blasted higher. Somebody knows something here. Perhaps this is the bottom for natural gas, and therefore somebody bought the ticker BOIL BOIL, the 550 calls for the expiration date March 10th, with expectations the BOIL will gain more than 13% by the expiration date. They paid around 45 cents a piece to enter this trade, all in all spending around $1 million. And then what about the ticker SPY, the S&P 500? Either somebody's hedging or betting against the SPY. They bought the 372 puts for the expiration date April 21st, with expectations that the SPY will lose more than 6.5% of its value by then. They paid around $4.50 a piece to enter this trade, all in all spending around $1.7 million. What about AMD? We know NVIDIA is moving higher after hours, so the assumption is AMD will do the same. And sometimes the call options for NVIDIA are really hot, really expensive, while the call options for AMD are cheaper. So somebody could be playing NVIDIA's earnings by buying AMD calls. In this case, they bought the 84 calls for the expiration date March 31st, with expectations that AMD will move higher by more than 10% by the expiration date. They paid around $2 a piece to enter this trade, all in all spending around $1.7 million. Now, what about the ticker COIN, Coinbase? The name reported earnings. It was higher in the morning and then it closed pretty much at the lows of the day. Really bad sign for a reversal, and therefore somebody's betting for more pain to come. And they bought the $50 puts for the expiration date March 24th, with expectations that Coinbase will lose more than 18% of its value by then. They paid around $3 a piece to enter this trade, all in all spending around $1.5 million. Last but not least, at the bottom of the table, and this could be an insider trader, maybe somebody knows something because they bought the 310 puts for the expiration date May 19th, with expectations that the name could lose more than 6% of its value by then. They paid around $10.50 a piece to enter this trade, all in all spending around $5 million. Onto the heat map, all over the place today. We know the dollar is moving higher, and therefore gold is not doing pretty good. Energy not doing pretty good. Chips are not doing pretty good for the most part. But we do have some dip buying here and there in the software cohort, in Amazon and Tesla. And of course, when natural gas prices move higher, we have the fertilizer names also moving higher, be it Mosaic, MOS, or Nutrien, NTR. We'll talk about them in details in the next video. But we also have certain names moving based on certain news. Example, NSC for Norfolk Southern. This is related to the disaster in Ohio. Now the CEO says they don't like it that people are calling it the American Chernobyl. And he says that there is so many misinformation going on here. This guy is an absolute disaster. Shut up and let somebody who's more competent to do the job here. Now, I did watch the interview with this guy and he sounded angry and drunk. If I was handling the PR for the company, I would say, hey, sir, stay away. You are a repulsive character. Nobody wants to see you. Nobody wants to hear from you. All what we need to do is send somebody competent, somebody likable to say, look, folks, we made a mistake. We know you guys are in a lot of pain. We're going to do whatever we can to help you out. And now I'm done. Now I'm going to shut up and hear what you have to say. And that's it. We also have Apple moving higher in the news that the watch will track your glucose levels, and if you have diabetes, and that's bad for Dexcom. That's all hype. It doesn't change a thing. Are they going to sell more watches now? We know if you have diabetes, your insurance, your healthcare, Medicare, whatever, they're going to pay Dexcom. They're not going to pay you to have a watch from Apple. So this is not the kind of news you want to pump the stock based on. And then we have news for the souffle Tesla. Our beloved governor, Kim Jong-un Newsom, is now begging Elon Musk to come back, offering incentives and no taxes and all of that. And the reason is, just about 2 years ago, the governor was bragging about the budget surplus that California was experiencing. Thank you to the IPO mania. But now that the IPO / the stock market mania is over, aside from the monkey rally, California is now experiencing a massive budget deficit. And this is due to companies leaving the state because of overtaxation and stupid regulation policies. Now Governor Kim is going to brag about, oh, we brought Elon Musk back. We have the best engineers in the world. We have the best facilities, yada, yada, yada. But what he's not telling you is how far down he went on his knees begging Elon to come back. And speaking of Tesla, we have another name, Luminar, the ticker LAZR. If you've been watching the channel for a while, you know that I'm a fan of this company and the CEO, but it was really, really overvalued at some point. Now that the stock is down big, is it an opportunity to buy it? Not from a traditional valuation perspective, but if you believe in the company's growth, they got another deal here with Mercedes. They're going to have LiDAR technologies, multi-billion-dollar deal, and therefore the stock was up big, exploding higher. Now here's more news for you from Mercedes. They're partnering with Google to bring Maps and YouTube into the vehicles. Now I don't know how you feel about Mercedes vehicles as of late because they look like a discotheque. with the lights and screens all over the place. You need an instruction manual to operate the car. When a lot of the buyers are seniors and older people, do you really want to make it more complicated for them? How about no thanks? And since we're talking about technology and ChatGPT AI mania, what is the point of ChatGPT, by the way? Can it do my job? Of course not. Can it help you cheat on an exam? Of course yes. Can you use it in JP Morgan Chase? Of course no. Because God forbid you might ask ChatGPT, hey, what do you think about Jamie Dimon, my boss? And the answer could be he's an asshole. What do you think about me working in JP Morgan? Would you like to continue to work in a criminal organization, sir, ma'am? And then we have one of the top performers today, Palo Alto. The stock moved higher because they have the efficiency. That's another buzzword. We're going to do efficiency. We're going to do AI. And stocks move higher. By efficiency, by the way, they mean firing some folks. But cybersecurity stocks were up big today. My favorite name is Fortinet. Used to own the name all the way to 21 and then got rid of it. Now, mind you, all of these stocks are overvalued. If rates go higher, they're going to go down. And then we have another mover, Intel, which was down big. But maybe there's a light at the end of the tunnel here because they slashed dividend by 66%. They have to do that. They're running out of cash and the company is becoming trash. So a lot of restructuring has to happen here. But the only thesis you buy the stock right now is the valuation. The problem becomes they have a long way to go, not just to fix expenses by reducing dividends and improving the cash flow, but they have to increase revenues too. At some point, the top line has to make sense too. And for now, Intel doesn't have any good answers for that. We also got news from FedEx. The company's pilot union is now striking and they're demanding better pay. I think they deserve better pay. The problem is all of that extra cost will be passed down to you and me, the consumer. This is more and more inflation in the pipeline, more wage inflation, which is one of the underlying conditions of the phenomenon we call inflation. And until this condition is dead, we can't say that we have a disinflation process in the economy. Last but not least, what about Disney? We have former VP Mike Pence, who now says that the dissolving of Disney's 50-year-old special tax status was beyond the scope of what I, as a conservative, limited government Republican, would be prepared to do. In other words, Mike Pence is saying, I'm a bitch for Disney. I'm a bitch for corporations. Please vote for me. That's the change that you Americans are hoping for. On to the heat map for the ETFs. All over the place, muted action across the board, but we know the dollar is up, so energy's down. XLE, XOP, OIH. If you own energy stocks, you might want to hedge by buying puts on the OIH. In a day like today, you're going to be protected. And if the Dixie moves higher based on the PCE inflation rating or whatever, puts on the OIH will hedge your portfolio. But when the dollar moves higher, gold goes down. GDX is down, GLD down, nothing new here. Rates went higher today. So we have the XLU for utilities down. Utilities are usually a substitute for rates. When bond yields go down, utilities become hot. When bond yields move higher, utilities become not so hot. Likewise, for the real estate sector, IYR, V&Q, all down. When rates go higher, mortgage rates go higher too, and the demand for housing goes down. Now, let's do some charts and then wrap it up when we begin with the SPY, the S&P 500 30-minute chart. What do we see here? Quarter rebound from 398, and it appeared that we have a rally on hand. We might close positive by a little bit. The problem is, as I tweeted midday, right before the reversal, midday update, we're seeing a reflex reaction to very oversold conditions on short-term charts. We're talking about the 15, the 30, the hourly, etc. This enabled some charts to climb back. Important numbers now turned into support. However, most daily charts remain in a reversal stage from bullish to bearish. We're talking about the daily now. Therefore, I'm using these reflex reactions to average down on some of my short entries and add some new plays as I expect the selling to resume. And immediately, the selling did resume, yet at the end of the day, the SPY managed to close above 398. What does that mean? The buy the dip mentality, the finding mentality is still here. It has weakened a lot, no doubt about it, but it is still here. Now that we have NVDA popping higher after hours, depending on how that's going to hold out in the morning, it could incite some dip buying appetite, or we see the SPY moving higher again. But if NVIDIA reverses and goes down, that is your leading indicator. The SPY, the Qs will do the same. And the reason is the daily chart's not looking good here. All in all, within range, nothing new. We have the negative divergence on the hour side, the MACD, the volume is moving higher. We have yet to lose 3,960. A weekly closing below this number means the bears are winning. A close above it means the bulls are still alive. But folks, I'm going to be honest with you here. The technicals are not going to matter a lot in tomorrow's activities. You know why? Because we have the PCE inflation reading on Friday. So the market mover is not going to be fundamental or technical in nature. It's going to be mechanical, number one, but most importantly, psychological. If the sentiment goes as we have another reading, inflation reading, this time around by the Fed's favorite measure, and if it comes out hot, we're going to go down big. So why don't I book some profits right now, use whatever rebounds, whatever pumps we have right now to book profits, and maybe bet against the tape? Then we're going to go down. We're going to de-risk ahead of the PCE inflation reading. However, if the sentiment and the psychology goes, wait a minute here, PCE could be the savior for whatever reason. It could actually show that the month-over-month inflation is not really that hot. Then that could tempt buyers, dip buyers, to continue to hold, if not buy more, and it could tempt shorts to panic and short cover. So the psychology will be more important than the technicals tomorrow. So we're not going to spend a lot of time here looking at the charts. With that being said, here is the Qs, 30 minutes again. We have a closing below the important line, 294.33, but we have a higher low. We know NVIDIA is up after hours, so chips will be up. A lot of dip buying will happen in the morning, assuming what happened yesterday is just a hiccup, a bump in the road, and we're going to resume the buying again. It all depends on the psychology regarding PCE, number one. Number two, what's going to happen with NVIDIA? If it reverses, then the assumption should be 294.33 will be lost again, and down we go to 290. But if the dip buying continues, then we have 295, number one, because that is the top of a reversal candle, and then we have the gap. Moving all the way to closing the gap at around 300 will be absolutely stupid ahead of the PCE inflation reading, because either you know the PCE will come out cool, or you're just speculating here and going against the mounting evidence that we got so far. Here is the daily chart for the continuous contract for the Nasdaq. What do we see here? The assumption should be, now that we lost 12,207, an attempt to recapture this number and close the week above it, and that will keep the bulls alive. However, if we lose it again, then we're going to go all the way down to the channel that you see, the megaphone channel, and a weekly closing below 12,207 will be a loss for the bulls, a win for the bears. For now, the volume is moving higher. The momentum indicators are in negative divergence, all indicating the more downside is coming. What about the IWM, the Russell 2000, 30 minutes chart? What do we see here? It caught 188 as support, and it looked so good for a little while, and then it lost it, and it closed the day below 188. This is a problem. We know that the Russell has been leading the mania due to small caps, AMC, Carvana, etc. Can it capture 188, and most importantly, close the week above this number? That will be a win for the bulls. But a reversal again, a loss of 188 as support, assuming it's going to be recaptured to begin with, will be a major loss for the bull, a major win for the bears, because we're going to go down to 183. What about the dollar index? 30 minutes chart. What do we see here? The moment the Fed minutes came out and we knew that, hey, we have more than two calling for 50 basis points, not in the next meeting, but in the past meeting, the dollar shot up higher, forming a bull flag pattern, indicating higher highs coming. The daily chart indicates that we need a pop. Could it be the PCE reading, which will get us all the way to 106? That could indeed be the case. And if it is, then gold goes down all the way to 1,763. Not good news for the old man here. It's about to erase the entirety of the year-to-date gains. What about UK oil Brent, a daily chart? We lost the trend line. That is bad news number one. Bad news number two would be if 77 is lost to support from a weekly chart perspective. And that could happen if we have a massive pop in the dollar. So keep an eye here. The 10-year yield, what do we see here? The bet should be we're going to get to 4%. Could the chart be waiting for PCE, or could we see the move happening as soon as tomorrow? And if that is the case, and the PCE comes out hot, is the 10-year about to go all the way back to the highs? If that is the case, folks, how could you justify that the Qs is not down where it was back in October, November? Not all of them, but at least most of them should be down there. And here's the 2-year yield, which is more important when we look at Fed expectations of rate hikes. Now, thank you to the viewer who brought to my attention that I had 5.24 written on the line. That was a typo. I didn't catch it. The line is actually 4.88. So if we get there, and we're getting really close, the conversation becomes, why is the Qs, why are the high beta names trading above the lows from October and November? And again, we're waiting for the PCE. Either it's going to get us all the way to 4.88 on Friday, or the move is going to happen beforehand. But if it does, the risk becomes, what if PCE comes out cooler than expectations, and then the 2-year makes a double top? This is what equities bulls are hoping for. What about the TLT? We're now at the support zone at around 100. We got a mini rebound today. Is it going to last or not? The assumption should be not until we get the PCE out of the way. How about the VIX 4 hours chart? What do we see here? It appears topping for now. When we look at the MACD and the RSI, the assumption should be, what if we get some dip buying in the morning tomorrow based on NVIDIA's earnings or whatever, and then we see the VIX going down to close the gap, only to rebound higher in the aftermath of PCE inflation. I'm just reading the tea leaves here. Apple, the big kahuna, 30 minutes, what do we see? We got a closing yet again below the important number of 150. The question becomes, will the weekly closing be below 150 or above? Below, the bears win. Above, the bulls are still alive. For now, we got a retest at 150. Didn't work out, but the chart made a higher low. And this indicates that we have another attempt coming. Is it going to be met with success or failure? This is what I will be watching for in tomorrow's activities. Another rejection at 150, another pullback from 150 indicates that that's a no-go. The weekly closing will be below 150, and then Apple is going to go all the way down to 145. Tesla, the souffle, 30 minutes, what do we see here? It did run a retest at the trend line, which is typical charting behavior. When you have a trend line, a major one, it is lost. We have a recency bias. The dip buyers, the gamma squeezers, they believe that this is not over, that this is just a dip. We're going to see Tesla moving higher because of Elon, because the revelation that's about to come, because God is going to come down, because whatever. The attempt now to climb the trend line was met with failure. Now they're going to give it another shot, and the reason is they managed to close above 200 for the day, which means another attempt to climb the line is coming. If it is met with failure once again, and the chart closes below 200, most importantly for the week, that would be conclusive evidence that the bulls lost and the bears are now in charge. Bitcoin, the daily chart, what do we see here? Now, a lot of folks are saying this is a bull flag consolidation pattern and a higher leg coming. That could be the case, but I am skeptical, and the reason is the dollar continues to move higher. If the dollar was going down, if the RSI on this chart was moving higher in positive divergence, if the MACD was also doing the same, I would have said yes, this is a bull flag pattern, higher we go. But because the dollar is going higher, because the RSI is in negative divergence, because the MACD indicator is about to cross to negative territory, I say you gotta be careful here. You need to see more before you jump in. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have initial jobless claims, we have GDP data. This will be a revision for the fourth quarter of last year. And then we have some zombies from the Fed speaking from Atlanta, Boystick, from San Francisco, Mary Daly. With that, folks, this is all I got for you for tonight. Apologies, I wasn't feeling so well. My voice is all over the place. But anyways, thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Take care.
You're just gonna have to stop shorting them all. That's ridiculous. I can't be...